How's it going, Professor Flores? My name is Miguel Magayon. I'm gonna try to bring some enthusiasm to this video presentation, which I'm glad that was an option, by the way. So let's get right to it. Again, name's Miguel Magayon. Hope you don't need my student ID number to figure out which one I am. So the final criticism that I'm going to be doing, the artifact, is fast money. The criticism I'll be using is the ideological criticism, and the component that I'll be dissecting is the arguments component. So let's start off with the macro perspective of what Fast Money is. Fast Money is basically a show. It's on CNBC, and if you have DirecTV, I'm not sure what cable provider you have, but just to double check, yep, it is on channel 355. The network is CNBC, and it's on from 2 p.m. to 3 p.m. Monday through Thursday, and then on Fridays it's on 2 p.m. to 2:30 p.m. Afterwards, it's another show called what is it? Options Actions, and unless you're into options, they're just mostly about long-term puts, long-term calls, and the strike calls and everything like that. Whole different ball game. So when it comes to Fast Money is a show. It's been on TV, I'd say about 10, 12 years now. It came from a different network, but once the producer of the show left that network, they brought the show over to CNBC. It's been on ever since. And basically, they get a lot of analysts who are very specialized in different markets and fields, whether it's technology, whether it's real estate, whether it's retail, whether it's consumer staples, whether it's general economists that are looking at the broader market in whole, and they'll ask them different questions, different inputs, and at the end of the show, they'll tell you what the best short-term trade they see is for themselves and for the viewers in order to make a short-term profit and not just have to put their money into a mutual fund and not have an edge in the market. So it's a great show. I like it. A lot of people like it. The ratings are up, so I guess it is a pretty good show. Um, so let's go into the ideological criticism. The ideological criticism and the arguments component, I think they just like peanut butter jelly, just like a cold Coke, some ice, just they bond really well together. And basically, the ideology of the entire show is that if you put money in the stock market, you'll make a lot of money over a long period of time. And if you make specific trades during specific moments within the market cycle or the economic cycle, downtrends or uptrends, you'll be able to make more money. So instead of making 10% yearly on a mutual fund, if you follow their advice and their expertise and you make specific trades, specific investments during specific moments, during a market's, a market or a stock's economic growth and their patterns and their charts, you could probably make 30% a year, maybe even 35% a year, every single year, just watching the show and doing what they tell you to do, sell and buy when they recommend. And that's pretty much the premise of the show. You'll make more money in the stock market than you will putting your money into a savings account or some kind of investment vehicle that doesn't offer a good interest rate. No compound interest. Now, the argument component is they're going to debate on the show which investment or which stock is a better investment or trade in the short term compared to other ones. So at the end of the show, sometimes a person might say, hey, I like Twitter right now, which I think is a good trade because a lot of the Democratic candidates are going to spend a lot of money on advertisement, and they're going to do so on Twitter and Facebook. So those two companies who will see a pop in the revenue growth quarter after quarter as we get into the election, because all of the candidates are going to be spending a lot of money on political advertisement. Another one might say, you know what, I like them, but I also like MasterCard more. And their argument will be Americans are really into credit card debt, and the reason we love it is because we want to have as high a credit score as possible. And the reason we want a high credit score is so we can buy a home, because everyone in America wants to live the American dream, and thus that requires owning a home. And then to get a home, you need good credit. But to have good credit, you have to have a certain amount of debt, and you have to pay that debt off every single month on time, preferably more than the minimum payment. So MasterCard is just getting more and more and more customers on a yearly basis. And every time some of those customers fail to make more than the minimum payment or they miss payments, the interest rate keeps going higher and higher, and thus the revenue goes higher and higher. And MasterCard's a good stock to own as well because we're a country that loves to be in debt. and So the arguments and ideological components, criticism, they really mesh very well. They're just different perspectives on the argument side, but they all contribute to the ideological criticism that you will make a lot of money in the stock market. So let's go with some. I know you wanted some scholarly, resources. So let's get into them. The first one I'll say is this one is a publication by. I want to make sure I get it right. 2008, Dr. Gizmo, and he's talking about trusting the stock market. This was published in 2008 again. He says, we study the effect that a general lack of trust can have on stock market participation in deciding whether to buy a stock. Investors factor in the risk of being cheated. That's very important because sometimes people invest money in the stock market and they'll buy a stock and it just goes down dramatically, and then they sell it and they do the opposite of what you're taught to do. Instead of buying low, selling high, they'll buy high, and then anytime there's any dip in the price of the stock, they sell immediately, jump onto another stock, and then when that stock goes through any kind of dip, they sell that one low. So they're constantly buying high, selling low. And this article goes to the ideology again. If you're going to buy stock, buy mutual funds, leave the money there, ignore it, don't touch it, leave it alone for 10 years, and it's going to be higher than it is today. But sometimes when, investors get antsy and they pull the trigger too quick and they sell off too quick, they feel like they're being cheated and the game is essentially rigged. Um, and that can happen too. Another one is so this one was published in 2018 by Dr. Edwards, and he talks about the article is, does future trading increase stock market volatility? And in this one, he says whenever high market volatility occurs, the tendency seems to be blame it on whatever news is going on at the time. Now, that sentence right there is powerful because a lot of people, when they see, oh, a lot of people are investing money in the stock market, that must mean that the economy is great. Sometimes it's not. It's just people are saying, hey, we're going to be dedicated investors every single month. We're going to invest money in the stock market, whether it's up or down, because over the long term, we're going to make a lot of money. And so sometimes people see the stock market slowly creeping up, creeping up, creeping up, but it doesn't mean our economy is good. You have to look at things like unemployment rates. You got to look at things as GDP. And so sometimes the market can be a little higher than the actual economic health is. And so sometimes the economy might not be doing too great, but if you're just looking at the stock market price only, it can be a little bit misleading. And then the next one we'll look at is for the works cited page. Um, this one is called Why Should Older People Invest Less in Stocks Than Younger People? Now, this one was published by an economist, uh, Dr. What is it? Dr. Rachel Noraya. And this one, let's get the date right. Yep, in 1996. And on this article, she has, and I like this one right here. It says, we look at the explanation that asset allocation is often shaped by large needs and reflect to the middle class, specifically middle class who are growing and aging. So this one, in terms of asset allocation being shaped, and it's basically referencing and talking about how the economy sometimes is shaped by the middle class because the lower class, people who are in poverty don't really have a lot of money to invest in the stock market, so they don't really make a big impact on the stock market. And rich people who are billionaires, they'll invest millions of dollars in Uber, but they won't really cash out ever because they're always thinking so long term. So really the people who are trading in and out of stocks sometimes are middle class people. Now they could be upper middle class, lower middle class, but they're middle class people. And so sometimes it's important to realize that the middle class have some of the biggest effects in the economy and in the stock market. And yet they also get destroyed on taxes too. Just crazy how that part works. And then my fourth and final scholarly research here is an article called The Stock Market, Profit, and Investment. And this one was done by Lawrence Summers, and it was published in 1993. Now, in this one, the quote I have is, should managers, when taking investment decision, follow the signals given by the stock market, even when those do not coincide with their own assessment of fundamentals? Now, this one's super interesting, and it's basically just talking about, well, sometimes they're, and like a hedge fund manager, for example, understands, okay, this is where the economy is, but some of these stocks I don't really like. I look at Apple stock. Apple stock is down. Why is it down? Oh, because of the tariffs we have with China and the trade war we have going on right now. So maybe Apple's not a great investment. Historically, it's always been. Historically, it'll probably continue to be. But right now, in a specific environment with tariffs, it's not a great investment to have. But the software and everything that they have in their firm says, hey, if Apple dips below 10%, 20%, 30%, historically, those were always amazing times to buy the stock over a long course period of time. And so their systems, their algorithms, their softwares will say, buy Apple stock at this price. It's already too low, too far off its all-time high. Buy it now. But the hedge fund manager will say, no, let's wait till the trade war is either over or Trump is out of office, because we need to get resolved before we see Apple having this amazing prosperity in terms of their stock, because right now it's going to continue to be hindered and held down. Those are things that they have to look at. Again, it goes back to the ideology. Ideologically, they're going to make more money over a long course period of time if they do invest in the stock market. That's their entire career field, hedge fund manager. But them specifically think, you know what? Average mutual fund grows 10% a year. But the reason the hedge fund manager gets paid $40 million a year is because they're going to make that firm probably close to 2-3 billion in 1 year. So it's $44 million salary. But in order for them to earn that money, they have to know how to make strategic investments, specific trades on a day in, day out, quarterly, monthly basis. And so sometimes they have to make decisions like that, which might not be popular with their investors, but they know it's in the best interest for them over a long course period of time. So those are my 4 scholarly resources. Talked about what the show is, Fast Money. Again, a bunch of analysts who specialize in different fields, different asset classes. They know what they're doing. They've been doing it for 30 years. And each one of them will give their opinion on stocks within their fields that they've been covering for years, and also give you a broader perspective of what they see the market doing and telling you what's a good short-term trade in the near term. And they'll argue about why their trade might be better than another trade, or why within a specific sector, like the semiconductor sector, they might like AMD, Advanced Micro Devices, instead of IBM, or instead of Micron, or instead of Intel. And they'll tell you why, and they'll give you great debates back and forth, within the allotted time of that segment. So anyways, that was the arguments component, the ideological criticism. Again, I like it. I'm all in favor of it, because that's something I do as a day trader. And so, anyways, so I hope you enjoyed the video. I try to do it within the allotted time, Professor. I'm already close to 13 minutes, but I felt that, man, that time flies back. And to do the 4 scholarly resources within the amount of time took more than I thought. But anyways, I hope you enjoyed the video, Professor. I'm going to stop it at 13 even. Have a good night, have a good day, and have a great summer.